Welcome. I'm Anthony Faso, and I'm a recovering CPA. I'm also the founder of Infinite Wealth Consultants. One question I get a lot is whether should I do a 15 or a 30-year mortgage. That's what we're going to discuss in this video. I will say that if you just look at the interest cost, you're going to pay less interest on the 15, no doubt. But what we're going to see the big picture. We're going to look at the true costs of each mortgage. And seeing is one of our principles of prosperity, SEE. We don't want to just look at one single financial transaction. We need to see how that relates to your overall personal economy. And that's what we're going to do. To be honest, I've been meaning to make this video probably for 6, maybe 8 months. I kept on putting it off. And I finally did it a week ago. And you know what? I really wish I didn't wait so long, because I thought it was just going to be between a 15 and a 30-year mortgage. However, going through this exercise, I actually learned there's a lot more to it than just a mortgage. And this is a good understanding of money and how money works. So I actually reshot the video because I want to make sure that I touch on a couple key points that, to be honest, I didn't even realize was there. So let's get started. Okay, over here we have our 15-year mortgage of $400,000. We're going to use an interest rate of 4.5%. Over here is our 30-year mortgage. Again, we're going to use a 4.5%. Now I know what you're thinking. Hey Anthony, a 15-year mortgage is going to have a lower interest rate. That is correct. For right now, we're trying to make this as simple as possible. Thus, I'm going to make everything equal on the 15-year mortgage and the 30-year mortgage. After we go through that exercise, I'm going to adjust the interest rates. Okay. Now, before we start diving into this, I do need to give you a warning. There's going to be a lot of numbers here. And if you've seen my other videos, I try not to show too much numbers, but hey, we're comparing mortgages here, so we do need to include some numbers. But I don't want you to get scared of the numbers. What I will do is if there's an important number, I'm going to go ahead and circle it so you can just kind of keep an eye on the important numbers. Now over here, your payment here is $3,059, and here it's $2,026. Now, before we go further, let me just show you one thing. A lot of times people are just insist that a 15-year mortgage is better. Okay, if a 15-year mortgage is better, meaning it's 180 payments, wouldn't a one-payment mortgage be even better? Let's take a look. Let's say that by chance you had, well, you wouldn't be by chance, you would not have $400,000 in cash, but let's say you had $400,000 that you had the option. I could get a mortgage or I could pay for it in cash. Now, one thing we need to look at is called opportunity cost. Now, opportunity cost, it means that you lost the opportunity to earn something else. So by doing A, by paying cash, you lost the opportunity to do B because you don't have the money. What we're going to do is we're going to illustrate the opportunity cost that you lost. If you had $400,000 in an account, and again, we're going to use the same interest rate. We're going to use 4.5%. And believe me, if you're not sure if 4.5% on a savings is valid, watch the other videos on the vault and the infinite banking concept, and we can show you how you can earn that plus more. So if you took that $400,000, paid cash, over 30 years, you lost the opportunity to have $1.5 million. That to me that sounds like an expensive mortgage. Now, what you may be saying is, Anthony, you know what? I've seen some of your other videos, and I know if I take some of my money, I am going to pay myself back. Perfect. So let's maybe you're going to say, hey, I hate bankers. And I don't blame you. Either do I. Bankers only want to loan you money when you don't need it, right? But when you do need it, they're not there to loan it to you. Okay, so if you take your $400,000, pay off the house, and you're like, I don't want to lose the opportunity cost. I understand that. But so what I'm going to do is instead of paying this 2026 to the mortgage company, I'm going to pay it back to myself. Oh, geez. Sorry about that. So you're going to pay this 2026 back to your vault or to your savings account. And after 360 months, you'd have $1.5 million. Doesn't that look familiar? Do you see why we want to use the same interest rates? Because that's where things are really going to come down to, is how and where we place our money. Now let's go dive deeper into the 15 and the 30. Okay, so we're going to go out 180 months. And let's take a look at the 15-year mortgage. Mortgage is paid off. And we've paid $150,000 to the mortgage company. Now let's compare it to a 30-year. Wow, look, we paid $229,000 in interest. And if that wasn't bad enough, we still have a balance of $264,000. Now, if we were to stop there, which is where typical financial planning stops, then of course a 15-year would be better. However, again, we're using the principle of prosperity of seeing, S-E-E, the big picture. This is not a fair comparison because over here we're putting in $3,000 a month and here we're putting in $2,000 a month. If we really want to get the right answer, doesn't it make sense that we put the same cash flow on each side? So let's take a look. 3059 minus 2026.74. Okay, we're putting in an extra $1,000 a month here. In fact, by 180 months, we're putting in an extra $185,000 over here. Now, what if we took that extra payment of $1,000 a month and we put it in your side fund that was earning 4.5%? You would have $264,000. What we really need to consider is, why do people want a 15-year mortgage over a 30-year mortgage? We've just proved that you're not really saving as much interest or a cost as people think they are. A lot of it is, isn't it, because you don't want that burden. You don't want that monkey on your back of having to pay that mortgage payment every month. And I totally understand that. However, if that's your concern, wouldn't that monkey feel a lot lighter if that monkey was only $2,000 a month? So when something does happen, you're not obligated to pay that extra $1,000. And then if you have the money here in your side fund, couldn't you pay off that house? I mean, pay off the mortgage at the end of 15 years if you wanted to? Or do you think over that 15 years, do you think life's going to happen where maybe there's a loss of a job, or you're injured, or maybe there's a family emergency? You know, a lot of times we talk about an emergency fund or when something bad happens. Okay, but so we do need to be prepared for that. But what happens when something good happens? What if there's an opportunity for you to take that money and invest or to do something else? Your equity in here is tied up. You may have more equity over here, but I tell people you can't eat equity. again, as I mentioned earlier, if you need money, the banks aren't going to loan it to you, right? Now, let's take a look at an even different scenario. Let's say let's go out 10 years. And let's say in 10 years, there's another financial crisis like there was 10 years ago. Your $400,000 house is now $200,000. Okay, put yourself in the bank's shoes. You have these same homes. They are, in fact, they're right next to each other. Okay, and they were $400,000, now they're $200,000. If you're the bank, which one would you foreclose on first? The one that has a balance of 164, that you know that you could foreclose and you could sell that and get the loan repaid? Or would you foreclose on this one when they're underwater $120,000? All right, the bank is probably going to foreclose on this one. Okay. Also, if that were to happen, and hopefully it doesn't, that means your other house, your neighbor's house, that was $400,000 is now worth $200,000. Do you think it would make sense if you took that money in your side fund and bought that house free and clear? Same house as yours, but now you bought it for $200,000. Couldn't you also rent that property, creating passive income? Where that passive income could either fill back up your side fund, or what if it made your mortgage payment? Then you don't have a mortgage payment and you have a house that you own free and clear. The point I'm trying to make is that we don't want to focus so much on the dollars. We need to focus more on opportunities. And which one are you taking on more risk? The one with the higher payment or the one with the lower payment? The one where the equity is in the house that you need to ask a bank to access it, or having the equity inside a side fund that is liquid and that you could use at your will? Okay, hopefully you are enjoying this as much as I am. Now let's dive a little deeper. Let's go out to the full 30 years. Now you're going to see here on the 15, we paid much less in interest than we did on the 30 year. And now what you could be saying is, hey, Anthony, you know what? Now that I paid this off, I'm going to start saving money now. I was paying that $3,000. Now I'm going to start putting that $3,000 into my vault. Let's take a look. Again, we're using the same interest rate, so everything is apples to apples. So at the end, at the end of 30 years, you have your house paid off, and you have $784,000 in your side fund or your vault, which sounds pretty good, right? But again, we need to compare apples to apples. Now in our side fund here, we're only going out 180 months. Let's go out 360. And, those are the exact same again. This is what I found so interesting when I did this the first time. Again, the 15 and 30 year, the numbers are equal, but they're not the same. You have a lot more flexibility with a 30-year mortgage. Okay, now we're going to dive even deeper, and this I found even more interesting. Okay, what we've shown so far is that they are about the same. Now, if we look here, what this amazing software does, this is taking into account all of the opportunity cost and if you were to save the money. And you know what's interesting, just in case you forgot, it says it's 1.53 million, okay? And remember, if we were to pay cash, we would have 1.5 million. And then if we paid ourselves back, we would have 1.5 million. So all three of these, no matter what you do, as long as the cash flow and the rates are the same, they're equal. Okay? The numbers are, but again, they are not the same because there's different benefits to each one. What we're going to do here. Now, as we shown, over on the 15-year mortgage, you paid interest of $150,000. Here, you paid $329 on the 30-year mortgage. Two questions. Is mortgage interest deductible? The answer is yes. Second question, would you rather deduct $150,000 or $329,000? If you said 150, please delete the video and unsubscribe because I am not going to be able to help you. But if you'd rather deduct 329, let's kind of see the impact on what that's going to be. Let's say that you're in the 30% tax bracket. Again, we're using the same interest rate on both. Because we have more savings in taxes of the interest, we can add that, or we can actually lower that to the net cost of our loan. Thus, the 15-year mortgage is actually more expensive than the 30-year mortgage because we have more interest that we can deduct. Now, there's one more thing we need to add to make this a true comparison. A 15-year mortgage, the interest rate is going to be lower than a 30-year mortgage. Before we adjust that, let me ask you, why does a bank lower the interest rate on a 15 over 30? Is it because 30 is in your best interest and banks are your friend and they want to give an incentive for you to pay less? No. I mean, banks are not your friend. As we showed earlier, banks are in the cash flow business. They use one of our other principles of prosperity of flow is having money flow through assets. A bank would rather have $300,000 a month coming back to them than $2,000 a month. So they're taking on less risk because there's going to be more equity for the bank to foreclose on a 15. I actually thought the mortgage difference between a 15 and a 30 was about 0.5%. Okay, now at that, it's still more expensive to have a 15-year mortgage. But actually, a couple weeks ago, one of my clients actually sent me a quote of the interest rates. And I thought it was a half. It was actually 1.25 less. So let's be accurate. Okay, at 1.25 less, the 15-year mortgage still it has a net cost. Okay, so let's see what interest rate the 15-year has to be comparable to a 30. 3.2, 3.1, nope. 3.0, nope. Close, but okay. Again, I'm a CPA, so let's just say, okay. 2.95. So in order for it to be equal, a 15-year mortgage is going to have to be over 1.5 less just to equal a 30-year mortgage. Even if that was true, should you do a 15 over a 30? You know, the bottom line is that the math showed as long as you keep the same cash flow, it doesn't matter. But what I would look at is which one are you taking more risk on, the 15 or the 30? Again, here you have a required higher monthly payment. Here, not only is it lower, but you also have a side fund that you could use for opportunities. But I think this shows that there's less risk taking a 30-year mortgage. However, that's not always the answer for everyone. We can't just focus solely on these numbers. If you are in retirement and are worried about cash flow, or if it always been a goal of yours to pay off your house, look, paying off your house is never a bad idea. Is it the best idea? That's going to depend on a case-by-case basis. I hope you enjoyed our version of the 15 and a 30-year mortgage. I would encourage some comments, and please feel free to share for this. And to make sure that you don't miss anything, I recommend that you subscribe to our YouTube channel. Now go have a fantastic day.